Well, good afternoon, investors. Welcome to our September 24th edition of Bull Sessions. My name is Mark Robertson. I am joined here by, I'm going to throw them all at you, Ken, the magical mathematician from mid-Michigan, Ken Kavula. Good
All
afternoon, Ken.
right. Hello, everybody.
I did leave out magnificent.
Thank you.
It's all good. And we also have joining us in the back room, Kim Butcher and Matt Spielman. Good afternoon, Kim.
Hello, how is everyone doing today?
And I want everybody to know that Kim has all of her work done for tonight, so she's headed for the pool here in a few minutes. And good
Oh,
stuff.
well, you're going to make me wait a whole hour, so I've got my iced tea waiting for me.
And good afternoon, Matt. How are you, sir?
I have placid weather, so I guess that's great.
Yeah, you don't have a hurricane incoming like Kim does, huh? Potential.
No, someone gets
hurricane.
it. It's you don't know what the chance is.
Yeah, that hurricane could change. You know, it could go more to Texas than it is going to the Gulf. Or if it stays in the Gulf, it could turn right and just go right over me.
Kind of like investing. It can choose a slightly different path that you had either forecasted or intended. So good stuff. All right, so we are actually going to be led into a little bit of a refresher course on some of our better selling disciplines that Ken and I have kind of laid out over the last few years. And as Ken just said, I don't know if we were live yet. They're not necessarily etched in stone. And we have modified our thinking based on a few findings and that sort of thing. But the general core concepts are still reliably in place. Fair statement, sir?
I think a very fair statement, Mark. We might be fooling with some of the specific numbers, but we really like the ideas themselves.
Absolutely. And we will be returning full force to our final 4 weeks of small company selections next week. But we kind of drifted off course a little bit, and that we would be me. And you'll see why. An interesting letter, and we will get things underway. All right, here is our weekly admonishment / acknowledgement that Portillo's is not a sponsor of this session, although they should be. And any Humphrey Bogart fans out there?
You're really digging deep now, Mark. Okay.
really aging our, us and our audience now, right? Digging pretty deep. Hot dog is a sandwich, and I do want to thank any of you who have either purchased stocks or hot dogs. I am a shareholder, and you'll notice that on the right-hand side we are approaching my cost basis. So, always a good idea. And the picture on the upper right is the premise behind the Portillo's infatuation.
Approaching the cost base is not necessarily a time to sell.
That's right. There's no anchoring here. I'll just put more mustard on it and go for more.
Well, the question is, while it was down, Mark, did you buy more?
Yes, I did.
There you go.
We're still below that cost basis. There you go. All right. So here are the ground rules. No investment recommendation is intended. This is entirely about education and demonstrating some, we think, pretty powerful philosophies, methods, analytical techniques, etc., all basically centered on the sharing of ideas, the sharing of investing ideas and how we look at those opportunities and basically take advantage of them in our portfolios. So you're going to hear opinions from us with respect to those methodologies that, again, are 8 decades in the making. Tonight is an example. Well, this session will be theoretically a little shorter because we do have our monthly roundtable tonight, and I did include a picture of Damsel as generated by one of the AI sources out there in honor of you, Kim, joining us tonight. Looks like that damsel can actually handle herself pretty well. Good
yeah,
stuff.
That's a pretty big sword there.
All right, so we will try to remember to disclose when we own something, like I just did. I own a small stake in Portillo's, and please make your own decisions. If you have any questions or if you'd like copies of the slides or suggestions for future topics, our 2 email addresses are there at the bottom of the page. Anything else, Ken?
Yeah, you probably own a small tube of Portillo's, not a small steak of Portillo's, right?
Oh,
Get those hot
please.
dogs out of the fridge.
Oh, please. All right. Well, just for that, you can have this one, Ken.
All right. It's not too often that all the numbers align perfectly, but the value line median appreciation potential right now is 8.7%, and the prove value for the entire manifest database is 8.7% at the midpoint, and the MyPAR number is 8.7%. That's a little bit below the historical average of the stock market, and that's why that light green bar is poking ever so gently right above that blue line of reasonable expectations. That's where we expect the stock market to grow at, and that curved line, because we're on a regular graph, represents consistent growth at somewhere in the 10% range, give or take a little bit. So we are just currently a little bit above that, which means the market, from our point of view, at least right now, is just a little bit overvalued, but it's still well within the range of traditional markets that we've seen over history. Nothing exceptional about the average stock. We do have some things to point out, and we're going to talk a little bit about selling disciplines right now. Remember that all the naysayers are forgetting that we are really either close to or two of the averages during trading today went to all-time intraday highs again.
Yep.
The S&P and the Dow both hit all-time intraday highs. They weren't there when I left my family room and the TV, but they were darn close. So whatever is going on, it's going on in a fairly orderly way, except for the reaction the day after the big interest cut. The anticipated 0.25 basis points turned out to be 0.50 not basis, they turned out to be 0.50 percentage points, 50 basis points.
Mm-hmm.
And the Federal Reserve gave the stock market a real kick in the rear end, and we had the best day, I think they said, since 2019 in the stock market there. Last Thursday, maybe, Mark?
That's correct. I mean, it has been a September to remember. The first half of September was particularly painful, and it has recovered nicely. And yes, that is a picture of the eclipse of a harvest moon on the right. I did not take that picture, but ours was almost that good here in Michigan.
We had that same moon and everything. In fact, I have a couple of pictures that are very close to that picture as well, Mark.
Yep.
I was kind of fascinated that the moon looked as huge as it looked that particular evening. That was a fact of the fact that the moon was as close to the Earth as it's going to be in some time. But it was gorgeous. It was absolutely gorgeous. So we had a clear day, and I was able to get some good pictures.
It was a great time. So we live in good times. Well, here's what Ken was just talking about. The recovery has been such that the market for the last year, going back to a year ago, when we picked our best small companies, Ken, back around here, as you'll remember, they started off absolutely on fire. And we're not allowed to talk about them. We'll bring them up one more time in early October, but we continue to be about 12 percentage points ahead of this performance on display here for the general market. And Eddie Elfenbein, for those of you that are not familiar with him, you can read his efforts at crossingwallstreet.com. He thinks and eats breakfast just like we do. So we have long considered him to be an ad hoc full member of investment clubs. If you're a stock watcher following one of Eddie's stocks, he will help you. And he's pretty good at what he does. And here he's just acknowledging that all-time high, as Ken was just talking about for the market.
Yeah, and to see that market mark up, in the high 30s or up into around 40% year to date, and then to tell people that our choices are beating that, certainly I'm going to cross my fingers and try to unjinx us from that, but it certainly means that that group of stocks is just doing fantastically this year. Better than anybody had a right to believe back at last November when everybody was telling us that a recession was right around the corner.
Oh yeah, we were inundated with people that were critical of anybody picking amongst the smaller companies back in that time frame. We can go back and prove it. I mean, they were out there. All right, here's one of my favorites that happens a lot. Of course, this is a reference to what Ken was just describing, the market taking off and reaching all-time highs recently. And then as Sean Mace is wont to do, he goes back and lays the curves on top of each other and points out that this is exactly what happened right before all of the nasty material hit the fan blades back in 2007. So you can actually go back and look at times when we're cut by half a point and point to some pretty nasty moments following it. That's why the rhinos are jittery on Wall Street, because they look at those isolated incidents and they remember. Rhinos remember.
Mark, have any of you guys looked at the BPIs lately?
I have not. I don't routinely check it, but go ahead and tell us what you're thinking.
One of my mentors taught me about looking at the BPIs, which is the bullish percent indicator, saying who's in charge, the buyers or the sellers. That's all it tells you. But of the 6 areas of the market I follow, 4 of the 6 are over 70. What happens when we get over 70? We are overbought. So I can understand why the rhinos are getting a little jittery.
Okay. Good stuff.
I think we could balance that a little bit by saying some of the basic problems with the banks do not, at least on the surface, seem to be in place as they were in 2007, 2008. So that might give you a little bit of satisfaction that maybe it's not going to be the banks that cause the next recession. And I just keep trying to keep a balance in my mind, at least, about the fact that we have lived in my lifetime through many, many recessions, and a lot of times they came and went without my wife and I even realizing that it was something we should be afraid of. Granted, that recession in 2007 and 8 was vicious, but that was the worst recession since way back in the Great Depression. So usually recessions are, while they slow things down a little bit, they don't cause a lot of the pain that I think a lot of the analyst community learned from in 2007, 2008. I just get the feeling that some of the younger folks on the television network, for example, are just unduly afraid of something that they've only experienced really in their professional career once. And they're going to compare everything to that one experience. And those folks that have lived forever say, hold on, they're not all like that. And they all be like that. So
I think this slide, I took this from the Wall Street Journal. It's based on some work done by Goldman Sachs, and it's just basically pointing out a couple of things. One, what are the rhinos jittery about? Well, they live with this perception of, one versus the other, recession versus no recession following that rate cut. And you can see the pretty good spread between the two. But Ken's statement is also very true. I can remember the depths of that 2007 recession and us comparing thoughts during morning phone calls about crazy looking stock selection guides. And that only persisted for another 10 to 12 months. And everything was basically back to normal. This is in 2008, early 2009. And so again, what do you really? I think you waste a lot of energy worrying about that. And then I found this from Ben Carlson over at Ritholtz, and I think this one actually captures it even better. I'm talking about what the market returns look like 3 years going forward from a rate cut that was made near all-time highs in the stock market, which is where we're at now. And that's a pretty good win-loss percentage from where I sit. And even as ugly as this was right here, Ken is absolutely right. It dissipated in less than a year for most of us. So I think this shows it pretty well. And if the average is a 14, 15% return over the next 3 years, historically, what are we worried about? Anything else here, Ken?
Well, no, but just again to repeat that most of you in our audience have lived through lots of recessions where you didn't fear for your entire portfolio, and I think we'll be able to live through a fair number more recessions where most of you will not be in fear of losing your entire portfolio. Yeah, there'll be some losses, but recessions happen. They're part of the normal economic cycle, and when is it going to occur? Well, obviously, the experts were telling us a year ago that we should be almost through one by now, and we haven't even begun one by now. So one will happen. I just don't know when to tell you it's going to strike, and nobody else can tell you either.
Oh, I know. It's going to be a Tuesday afternoon.
Okay.
All right.
I'll write that down, Mark.
All right. Here is for the Ardelyx herd watching Ardelyx. Kim found this the other night, and we're really hopeful that Simply Wall Street's right about $63, because if they are, I'm going to throw a big party. Drinks for everybody. I also think that this is perhaps a look at, and I haven't looked deeply into the Simply Wall Street analysis, whether it's algorithm driven or robots or whatever. Sometimes this sort, the average analyst out there has a fair value closer to $10 or $12 a share, just to give you some context. And those of us that own shares of Ardelyx will certainly gratefully accept 63, but and do a cartwheel while we're doing it.
Now, Mark, did you generate the graphic on the left-hand side of the screen there?
Well, Sean Mace did, because he likes to keep track
Sean did? Okay.
Yeah, he likes to keep track of the animals that are involved in our
So
community.
there's no bulls. There's no bulls in this picture. Did you notice that?
I need to inject our bull into that picture, maybe. Maybe
Yeah, I think they're all bears and rhinos with a head of a deer, maybe. Yeah.
Well, there's a groundhog, I think, well, maybe not.
That might be a groundhog over the one knight's shoulder. I'm not certain. Okay.
That might be a damsel in the coat of armor too.
It could be.
Could be.
Concealed. Good stuff. All right. Keeping pressing on. This is our weekly checking in on longer term performance perspectives. And as you guys all know, we went back and made all the dates September 2014. So we're basically looking at a 10-year results chart here, with the exception of the 10 cup portfolio, which goes back to when basically I started getting really interested in investing, and the investing roundtable, which again meets tonight, which is hovering near a 5% relative return since we started that 14 years ago. So again, it's just a quick reminder that how the stocks that are most commonly followed by our community have done. That's going to dovetail pretty importantly with a little bit of Nick DiVirgilio inspiration that we'll talk about as we talk about future stuff here towards the end. So it's just
Mark, I did get a question when I was in Traverse City last weekend, and somebody asked me when I thought CVS would fall out of the top 10 in the manifest most popular. And I said I didn't have the data or the interest in finding out, but I would ask the question at the next roundtable. So I'm true to my word. I'm asking the question, is number 11 fairly close to number 10 so that CVS might fall from this list at some point?
Well, first of all, CVS is 7th or 8th.
Aha.
So they are
Okay.
not even number 10. Second of
Okay.
all, we did pick CVS at the national convention. So I mean,
Yes, one of our knights, one of our original knights picked CBS, right?
yeah. So the answer to your question is I don't know. I think Stryker might be number 10, but
Okay.
Nvidia is number 11.
Oh, all right.
So
Well,
that's
let's get that baby up onto this list here.
can't force it, but yeah, that one is hanging in there. Pretty sure it's number 11. All right. So with that, here's a quick look at our groundhogs. Not too much activity moving around. As Ken noticed a little bit earlier, some of our bolded entries, which are the investment clubs, have slipped into that log jam between 41 and 50. But again, my name's not quite on here yet. I had a pretty good week, but I think I still only ended up in the 70s. And Ken, you continue to hold down. Where are you on there? Number 22.
I'm at
So you're
22, and as long as I can stay on this list, I'm going to be happy. Okay. And Kim is on the list, and again, I just want to shout out to Don Sheets, who's in my investment club, who is just ecstatically happy about this placement of number 13 today. So Don, congratulations. I hope you keep moving up the list here.
Well, he's got some work to do to catch the leader, but he could make some steady progress. It's a tight race. I mean,
Well, I think Don's goal has always been to beat number 22. So,
well, yeah, I can relate to that, Don. I can completely relate to that.
If I can stay consistent and be in the top 10 every year, I'll be thrilled.
Yeah, there's some good stuff on there. Of course, there's the Moose Pond people. That's Ty Hughes's club out of the DC area. And we're going to talk for just a second about Sean Mace because he's our biggest mover this week. Some of you have heard him here before. In full disclosure, that is not a Portillo's hot dog, and we're admonishing him for that. That is a Costco hot dog, which means that Sean is value conscious and aware. So good stuff there. And that is his portfolio on the right. You can see that he does have Portillo's in his groundhog portfolio, along with 3 other stocks and then a couple of leveraged exchange traded funds to achieve.
Yeah, I think if I were a member of the Investment Club of America, I would be looking over my shoulder and getting a little bit worried. I notice Bauer City keeps moving up 1 or 2 or 3 spots almost every single week. They've won this thing 3 times as the best club.
Yep.
So let's see where they're after. That investment club is number 4, and we still don't know anybody that's in that club, do we, Mark?
We did find a list of names, and
okay,
we were talking about them during that Wednesday morning breakfast. So yeah, I do have the people identified. So if they persist up there, we will definitely get to know them a whole lot better.
Great.
Good stuff. So the groundhog continues to hover. Excuse me, groundhog. The monkey, the dart tossing monkey, continues to hover close to Ken just to annoy him at number 24 there. And Kathy Wood continues to languish. The average return is shown there on the right. You guys all know the drill. All right, so pressing on. This is kind of what led me to a bit of a distraction. This week, a letter that I had found in some correspondence from Alejandro down in Paraguay. And he's been around for a while and he had some questions. And Ken, I'd like to officially put this on the travel log next to Punxsutawney. I think Punxsutawney, I note that it's fairly close to Sao Paulo. So you said you don't want to drive to Paraguay?
I have no desire to drive this far, Mark, okay?
But
I know there's a road. I don't want to take it, okay?
But we can fly into Brazil and maybe take that trek across the state of Parana.
Yeah, so what is that, 1,000 miles from Sao Paulo to Concepcion?
Well, anyhow, that gives us a latitude that we can relate to as to where it's at. Uruguay is right next door. That is actually on kind of a bucket list for us. But so the Paraguay is now on the list of places that we probably ought to take a look at visiting. All right, so here's basically where he's coming from. And He had looked at some videos and he just wanted to kind of go through some of the stuff that we have talked about, like a decline in quality. We'll talk about that a little bit. And this rule of 5 timeout thing that we've kicked around a little bit. We're not going to cover this one this week, but we'll probably come to it next week or the week after that, dealing with core slash non-core companies versus and including a little bit of the small company element in that. And then this very popular subject. Every time I hear when to sell, I basically switch it in my head to why to sell. There is no timing on it so much as conditions, in my opinion. So, Ken, this is something we have kicked around for years. I thought maybe we would just take and capture some of our presentation materials for a couple of minutes and just reinforce these a little bit. What are your thoughts going into it?
Well, and I think you begin such a discussion by quoting from one of the old NAIC investor manuals when the topic of when or why or how to sell stocks came up in the manual. The answer was a very simple sentence. You sell to make the portfolio better. And I think that's still the overriding answer to any when to sell discussion. Everything else, I think, is cloaked in a little bit of mystery sometimes. The tax man gets involved occasionally. Dividend timing is something you kind of worry about taking into account. You worry about the fact that you always want small, medium, and large in your portfolio. And a lot of times there's a lack of small because the smalls have become mediums and the mediums have become larges. But the overriding idea is you sell to make the portfolio better. And to me, that means that you focus on return, on portfolio return, and you try to keep it up there. You try to keep the potential return, the anticipated return. You try to keep that up there. And you know the goal, folks. You're trying to beat the market by at least 5 points. But if you can only beat it by 1, you're still doing wonderfully.
Yeah, the methodology is strong and it works. So this is just basically taking it and deploying it in the realm of portfolio management. And Cy Lynch does a number of presentations on portfolio-centered decision making. So again, that's not a when question, it's a why. How do you make the portfolio better? By selling a stock and replacing it with something which strengthens the portfolio. So like Ken said, just make sure that you're in the design ranges for the characteristics of the portfolio, and that is a reason to sell. Second of all, it can be a company specific situation. And this is one that he was asking about. Do we still feel the same way about quality? And the answer is yes. We'll try to clarify that. I don't know about you, Ken, but this is one that I have the biggest challenge being disciplined. As we gauge the changes, I do think that changes in management are worth noting. They can be good, they can be bad, but anytime you see those red flags that we know is slowing growth or deterioration of profit margins, and of course, if there's anything weird going on, that's of course that's a time when wind goes out the window most of the time.
Well, and Mark, I had to adjust my discipline 15 years ago to also include watching the quality graph. You so kindly calculated a number for quality and then gave us a graph of that quality over history. And I never used to have any reference point to give me something that I could actually watch and see quality decline. So I had to adjust one of the things that I did when I was considering selling, and now it becomes part of what I do when I evaluate or just take a hard look at a stock 2 or 3 times a year that I own. I'm always checking that quality line, because when there's degradation or serious deterioration in quality, that could be enough of a reason to put the stock on the chopping block and to replace it. And again, when I'm doing that, I feel that I'm making the portfolio better.
Yeah, so it kind of falls up into that top one. And then of course the last reason is you need the money. So again, you're going to take and figure out what are the weakest expectations and sell those until you have enough money for whatever the personal need be at the time. So again, in a nutshell, um, even that can be an opportunity to make the portfolio better. So everything kind of falls under that number one. And in our experience, I can only think I can probably fit them on two hands. And we've made 1,000 decisions in the roundtable tracking portfolio. The number of times where the wheels have come off are actually fairly limited. So the vast majority of the decisions are driven by this central notion of making the portfolio better.
You know, Mark, even one of the hardest lessons for a teacher to learn is that no matter what you do in a classroom and no matter who you might take out of the classroom, there's always a student that's going to bother you. There's always one near the bottom that's going to push your buttons and everything. And the same thing's true in a portfolio. No matter how good a portfolio is, there's always going to be one, maybe two stocks that are just a little bit less perfect than some of the other ones. And by moving them out when you need money, you're still going back to number one to make the portfolio better.
So anyhow, that is the guiding principle behind why to sell. All right. Here's just our quick reminder that we think that a current, fully up to date study of the company is the most important aspect of the decision in the first place. And as Ken was mentioning, on the right-hand side, we graph the quality over time. We'll actually look at examples of some of the stuff we've been talking about. But step number one, if you're thinking about selling a stock, you want to make sure you've got a pretty good handle on the current status, current condition. Think of it as a situation analysis for the company you're thinking about taking an action with. No different than buying in that regard.
Yeah, and that line that I was referring to is that blue line on the right graphic there. That's showing me quality, and I want to see it. I'd love to see it horizontal up above 90, but I'm only going to start to worry when there becomes significant degradation. If that downturn that happened about 2/3 of the way along the line would have continued and moved that down 10 or 15 or 20 quality points, I would have had some real issues with this stock, no matter what the stock happened to be. If there was degradation like that going in quality, I would have had some problems with the company.
Well, I think that
this is just a little bit of wind in the willows. That's all this is right here, a little bit of waving around back and forth, nothing serious.
I think that downdraft in quality had to do with that time period when they were thinking about raising the price on the hot dogs. And I'm kidding. And then
Everything goes back to hot dogs, right? Okay.
Charlie said, "Thou shalt not raise the price of a Costco hot dog," and they listened, and everything went back. There you go. Just kidding. All right. Here's another aspect. Again, as you're going through your studies, my encouragement would be to not get too hung up on the zoning. I'm not saying ignore it. My attitude is don't let it distract from the rest of the most important stuff. The most important thing for me is the output of a stock study is the return forecast. And the rest of this here is just issued as thing that Ken and I have wrestled with for years. Those are realities on the right. And it's also a reality that when George Nicholson put together the original stock selection guide and put together the zoning and all of that, it was because he really didn't have another choice, and it was absolutely ingenious at the time. I think we have better real-time tools these days, so just keep that in mind. Again, I'm not saying ignore it. I'm just saying perhaps change the amount of emphasis on it. Because without sugarcoating it too much, I mean, I attended a club meeting recently where they argued about the low price selection on a company for the better part of an hour. And it's not worth that argument was not worth the time they spent on it. They could have been spending it on some other, in my opinion, higher priority areas. So is that too much soapbox?
No, it's not. And again, I think you have to go back to some of the original writings coming out of the Association of Investors, Better Investing Today. And some of the original writings made it quite clear that the stock selection guide was an aid to judgment. It
Yes.
had nothing to do with being a black box. It wasn't a machine to automatically tell you when to buy, hold, and sell. It was just an aid to your judgment. And the more experience you got, the more it could actually help improve the judgments you were making. We all know, those of us with lots of experience know that you can come up many times with upside downsides of less than 3 to 1, which we're not supposed to be buying in that range. But if the par value is extremely attractive, we know that there are certain stocks on the market that if you really want to take a position in them, you're going to have a very difficult time taking a position at a fair 3 to 1 upside downside. And the one that we just had up on the screen, Costco, is a great example of that. You might have to stretch your rules a little bit to buy some of these higher quality stocks. And especially ones that are so consistent over so many years.
Yeah, and just one last thought on it, and then we'll move on. I had written a paper years ago that basically made the case that Microsoft was never in the buy zone for the first 20 years it was publicly traded. And we know that's not true. Just point blank, it's not true. So chew on that a little bit. All right, here's a look at that quality degradation thing. And this is also a very important reminder to listen to those around us, because back in approximately this time frame right here, and you can go back and listen to it on YouTube, Ken made a very elaborate presentation on how Fossil was in trouble and Fossil was in danger. And we all sat there and nodded our heads, and we continued to hold it in the roundtable tracking portfolio. So Ken, should we pay attention to degradation and quality?
Absolutely, because it's important occasionally to preserve capital. And as degradation in quality begins and capital moves, the original amount of money in this imaginary portfolio was $100. So when it moved down to the 45.50, we probably should have preserved that amount of capital and left and put that capital to better use and made the portfolio better. Instead, we chose to hold Fossil all the way down and finally got out in the $10 to $15 range. And you can see percentage-wise, we lost 85 to 90% of our capital, which is not a good thing for you to do.
Yeah, this is an example of stubborn for me. I mean, we were stubborn about Fossil, and you just have to overcome that emotion sometimes. This is the type of tool that can actually help with that, in our opinion. At some point, and the point that Ken has talked about quite a bit is, when this thing starts off at a quality rating of near 100, and when it breaks below 80, that is definitely a time to give it some serious head scratching and some thinking. So that's what we would encourage.
And this is also a place where Mark and I have had a very difficult time figuring out exactly how many points of degradation do you need to get a sell signal. And we're thinking there's probably not a specific number. It's more of an art in picking out when you finally, in hindsight, I would have loved to have sold it when the quality was still up there and the stock was still trading around $60 or $65. But that $45 to $50 range held on for a reasonable amount of time. What's that red bar signify? About 8 or 9 months there.
Oh yeah.
It was some time for us to think about it and get rid of it. Yeah.
Yeah, I have thought about going in and looking at changes in quality, the delta and those changes, and looking to see if there might be some type of a tipping point trigger. We may still do something along those lines, but And this is probably one that qualifies.
We're getting some good questions, Mark. We have a couple folks in the audience that want to know, are there other sources for quality ratings? And I think that a lot of data sources put out quality for various things. You can get financial strength ratings from a lot of rating sources. Companies are especially trusted companies are eager many times to give you their idea of quality, but this idea that Mark has put together goes back to some of the original research done in the 50s when we're talking about value investing for the first time in history. And when you put together the 4 pillars that make up this quality, the quality rank itself is put together numerically. It makes a lot of sense. And if you want to find out how the calculation is done in Manifest, then go to the Manifest site. And Mark, give us the citation for the article again. I know it's "Oh Captain, My Captain."
Yeah, you can simply Google the word excellence. Don't use quality, but use the word excellence, and you actually go to a public article, which will help you with the definition. The other thing I would point out, first of all, Ken's right. If Value Line goes from an A rating to a B plus rating, first of all, they're more stubborn than we are. They don't move them up very fast. They don't move them down very fast. So that is one example of an area where you might pick up something like that. Here's another one. We don't even have to identify the company. This is a company in trouble. You can see that their operating margins and their net margins are on the decline, and the stock price obviously has suffered rather dramatically. You can also see out here on the right that their forecasts are headed downward in their 3 to 5 year forecasts. So just some other things to look at. Again, that one can come straight from Value Line if you want, but this is one of the biggest red flags we note during our stock studies when our profitability begins to lag or weaken. So you don't have to have the quality at your fingertips to recognize this.
And I think Mark is showing you 2 values that are right on the Value Line sheet, operating margins and net margins.
Yes.
We happen to use pre-tax profit margin in the SSG, and that number is not directly on the Value Line sheet, but it can be calculated pretty quickly. I think the idea, however, is that whichever margin you're going to pick, they're all going to be moving in pretty much the same direction once the company gets in trouble.
Yep, so if they don't start recovering from that, this one's going to stay in trouble. All right, let's talk a little bit about this rule of 5. We've characterized this as a timeout for a holding. Think of it as not necessarily an automatic sell, but more of a trigger as an alert to give it some thinking. And it's based on William O'Neill's Investors Business Daily originator of their process of their momentum investors. So they think about the world a whole lot differently than we do. And they have this hard and fast rule to sell if a company drops 7 or 8%. We took a look at that, said that's intriguing, maybe a little bit compelling or curious. We said we'd like to do something similar, but we want it to be relative to the market. We want to account for those periods when the market drops. So again, trying to keep it simple, but we do believe that if you pick a stock and it begins to drop faster than the market after you buy it or watch it, it is worth, another dose of head scratching. Fair enough, Ken?
Fair enough. And that brings in this idea of relative return. How much has it lost to the market, or how much has it gained to the market? And when that relative return reaches somewhere around -20, and there's one of the numbers that we thought we were pretty firm on and found out during the pandemic that we couldn't bring ourselves to use that number a lot of times. So I think Mark added the word consideration/analysis to the slide.
Well, it's worse than that. We're not disciplined. We're running amok, but I do think that this is probably a pretty good trigger point, and it's not a hard and fast number. And I will go further and say that we're trying to figure out, well, when would you perhaps not think about this? And I think we'll come to that in a minute when we talk about companies with extremely strong growth. Maybe that's a time when you give it a little bit more leeway, and that would be certainly very consistent with stuff. Now, if you've got a non-core company that does this, or speculation, I would suggest that maybe you adhere to this pretty carefully.
Well, and I also think, Mark, that we got into quite a discussion about this when the banks in San Francisco failed a couple of years ago,
Yes.
and dragged down all the regional banks with it. They certainly had relative returns at that point that were significantly less than the market was returning, and we stopped and paused and said, look, we didn't think it was right to get rid of them. In fact, it might be right to accumulate some of them that don't have the kind of problems that caused these two banks to fail. And maybe the market psychology for that industry was just really out of whack at that time.
Great
so
point.
We didn't institute this concept, you know. We're taking everything that we say with a huge grain of salt, and we're willing to break our own rules. I used to tell beginning teachers that came in and complained about so-and-so doing something in a classroom, and I said, what rule did he break? And she or he would tell me, and then I would say, and who made that rule? And they would tell me they did, and I said, well, change it. If you don't want to punish him for a rule you made, then change your rule. Don't bring the kid into punishment. The same thing's going on with the stocks right here.
Yeah, and in case you're listening, Kevin, I do still hold shares of Western Alliance to this day. Here's an example of what we're talking about. I had made a presentation to the roundtable on Iconics brands. It was back in April of 2015. And during that session, we actually talked about adhering to this rule, believe it or not. Well, 4 months later, the company had declined 23% while the market was basically flat. So we actually did sell it and walk away from it in the round table portfolio. Well, it proceeded to go from, it was started at 26, and the next thing you know, it's down in single digits. I often cite this as an example of a company that I theoretically owned and lost 80% 3 times, because it dropped 80% 3 different times to eventually go down to close to zero. The point being here is we got out with, we always invest $1,000 into these companies at the roundtable. We got out with 700. That would have been $7 a year later. So this is an area where that rule of 5 timeout driven thinking really could be most helpful and probably most applicable.
And nothing would stop us from moving back into Iconics if we thought there was a good reason to, right, Mark?
Well, except that I have completely removed it from all of my electronic devices.
Okay, from your memory. All right.
Oh, I still remember. All right, here's just a really quick answer. Is this all worth it? The question is, all of this selling stuff, these disciplines that we're trying to learn and adhere to, are they worth it? And what you're looking at here is a what if. What if we had never sold anything in the roundtable? You can see the top chart there. The roundtable has about a 17% rate of return, 16.6 when this slide was made. And I just went back and said, well, what if we just turned them all off and bought everything back that we sold? What would it look like then? And it drops it down to, call it 13. That's an enormous, that is very material, very significant. It's the answer to the question, is it worth it? Now, does that mean that you're not going to sell an Oracle and watch the darn thing go up 900%? That will happen to you. And we try not to look at those because they make us crazy. But taken collectively, those 600 sell decisions or whatever the number is have actually added to the overall portfolio performance over time. So that
and these are relatively recent figures too. Notice the slide is dated. These came from the Chicago convention last May. So this is recent stuff. This is not stuff that we pulled out of history and trotted out to make our point. So
absolutely. Thank you, Ken. All right. And so here's one of the overarching rules. And it's one of Ken's favorites, so I'll let him get on his soapbox now.
Well, this comes from the 1980-something Investor's Manual from NAIC. And I have 8 or 10 quotes from this manual that I I remind myself of on a regular basis. And this is one of my most favorite quotes. And it came to me later than a lot of the other quotes. In other words, I had read this a number of times and didn't really read it, didn't really assess its value to me as an investor, and didn't really think that it was something that I could use the first couple of times I read it. But basically what it says is try to avoid selling stocks when the sales and earnings lines are pretty consistently in double digits. When that's happening, you do better just to hold them. You do better to be a buy and hold investor when, and again, it's when you have this earnings growth and this sales growth in double digits, 10% or better. And when that's happening consistently, then really try to hold back in selling. I listened to a panel discussion on Costco this morning on CNBC, and Josh Brown took two of the members on the panel to task for suggesting that Costco might have slowed down and it was time to get out of the company. And he said this was a company for the ages. It was one of the first companies he ever owned, and it was going to be one of the last companies he ever gets rid of. And he made the same general kind of point that when a company is operating the way Costco operates, and when it maintains sales growth and earnings growth the way it maintains sales growth and earnings growth, even if your signals are saying that you might make a really nice short-term profit, it's better to hold it. If you have to trim it back a little bit because it's become too big a part of your portfolio, isn't that a terrible problem?
That's a different discussion. We don't have that one in.
Different discussion, right?
I think I'd like to invite those two panelists to go with me to Costco on Sunday afternoon in Lake Orion, Michigan. All right, so a couple other things. We do actually use the relative strength index. If you're not familiar with it, there's a link to stockcharts.com. It's free. You can learn more about it, but it's the math behind when they describe something, and they being generally the talking heads, whether a stock is overbought or oversold. And again, we're not going to go deep into it, but we do use that as a trigger, and we'll do it at the round table. If we actually like 80 better than 70. If a company gets up to 80, we will actually have an active discussion about selling it or taking advantage of a selling opportunity or deciding not to. Same thing on the other end, oversold. If it gets down around 20 or less, it starts to get pretty intriguing. So that's just there for you to consider. Again, it's used as a trigger to fully consider the situation. Same thing here. Here's NVIDIA. The point we want to make here is that this relative strength index thing can go for a long time. And you can make a case that every once in a while it will hit that situation like you see here and then go into either a flat spot or a slight downtrend. That happens often. And that can actually be, in some cases, your excuse to wait. Because here's the next 6 months from that graphic. And you can see that once again, this is where we were on the previous page, right here on the left-hand side. It proceeded to get all the way back up to here, hit this point, and now you can see that it's actually once again gone into a bit of a holding pattern. So this is NVIDIA. So if you're thinking about NVIDIA, maybe you wait for it to get down to one of these moments in the future.
And we could drive the point home, Mark, if you go back to slide 23. And I would just ask the question, the first NVIDIA slide, that one right there. I would just ask the question, the very first time that it went above 70, which is over just after 2024 begins, maybe to the left of the second red arrow, way over to the left, Jet. Keep going there. Right, no, well, I'm talking about when it first hit that,
even this one,
that oversold part. Okay, that one. Imagine how you'd feel if you sold it because it went on the technical advice over 70 or over 80. There it is going over 70 a couple times again about 2 years later, or 2 months later, excuse me. And imagine how you would feel if you had lost all of that and then had to jump back in or tried to jump back in on a stock like this. These are just guidelines. They're just things for us to help discuss.
Yeah.
They are not trigger points to make a sale. We don't want to make that give you that idea. They're just discussion ideas. That's all. That's all
These are days. I mean, you sell here, you're down to, and you'd have to divide these by 10 at a 10-for-1 split, but within a couple of weeks, you went from 65 back up to 90. So again, use them as entry points and entry triggers for further consideration for buying or selling, and don't get too hung up on them. Okay, we're going to talk about this one in greater detail in weeks to come. The point I want to just leave the audience with for you to think about is we believe that the point at which you sell a stock is a function. And again, we're going to develop this thought more fully, but it's the function of the quality of the company. And so we are slower to sell a high quality company. We basically are only willing to sell it if its par drifts down into 0 or negative digits. That is not true for the Iconics brands of the world where they're non-core. We are willing to sell that when the company is closer to market averages on the right. So we'll come back to this and explore it in more detail. That probably comes closer to explaining it better, Ken, than I did the first time. But we'll come back and fully develop this thought. Because again, look at the prices at which you would consider selling the stock and how much of a range there is down here on this bottom line. So again, depending on whether the company is blue chip core versus non-core makes a big difference in how you think about at what price would you sell. Fair enough?
Hey, fair enough. Fair enough.
All right. So with that, here's your summary. We're coming up on about an hour, so we'll continue to get preparations underway for tonight's session. But again, it's not necessarily when, it's why to sell for the 3 reasons we have mentioned. Think about red flags. And we really do think that adhering to this stuff, you saw it with the roundtable tracking portfolio. I know absolutely that my personal results in my personal portfolio are probably even stronger, where the selling has made a very positive difference, except in those areas where I got too stubborn, but subject for another day. Can only admit so much in one day. And then you can actually go back and listen to a version of this presentation. Some of the stuff might be presented a little bit differently, but again, Successful Investing 3, Managing Your Portfolio, dealt with this issue completely. And then as I promised you, we are going to be implementing and watching this stuff with the Buttonwood Bulls portfolio. So that's an opportunity to watch that in action, because we will be following these, at least attempting to maintain some discipline and follow these, Ken, with the Buttonwood portfolio. Anything else you'd like to add?
No, I think that we did a pretty good job in keeping it to an hour today. So we want to invite everybody that's here to come to the roundtable this evening. Folks, if you can't find a link and you want to come to the roundtable, drop me an email. I'll be glad to send you a link immediately. It's kkavula1@comcast.net. And if you need a link to the roundtable tonight, send me an email and I'll send you the link right back.
All right, here's your reminder that we will return to our quest next week. You see Ken's playing around with his AI with the bunnies on the upper right. Small cap is not necessarily a small company. Here is the portfolio of the Buttonwoods and the 3 companies that are currently in the somewhat vetted box, and I will probably choose from one of these tonight. I haven't chosen my stock for tonight yet. And I'm kind of going back to those 3 that have been somewhat vetted and are interestingly enough to take a closer look at. Here's your
Well, and
reminder.
Mark, I want to make one more comment on Buttonwood.
Sure.
If this is a real club and we're trying to run it like you run a real club, then at our next formal meeting, I think we should also probably take a look at Viva Systems. And the only reason I'm looking at it is it's the lowest par in the portfolio at the moment, and we should take a look at it to make sure that it's something we still want to hold, we still want to keep in the portfolio.
And again, that's done in the context of making sure this number, which is the average return forecast in the portfolio, is at the right level.
Absolutely.
Okay. So it's been pretty good so far. And yes, Kevin, we do still have Western Alliance in this portfolio too. All right, here's your reminder that we do archive all of these presentations, whether they're bull sessions or roundtables, as we'll do tonight. You can see there's a special Arizona presentation on here also, and they're available at YouTube under Manifest Investing, so you can go and look for that. If you do subscribe to it as shown here, we'll make you aware anytime new content is added. Then we do have a couple other coming attractions. We're going to continue that discussion with that sell point analysis, along with answering this question about non-core, calm special situations or whatever. We'll go a little bit deeper into that. Again, coming back to that proof concept a little bit. Back here Tuesdays at 2, a week from now. And then last but not least, on the far right-hand side, Ken, I know we haven't talked about this yet, but a discussion with Mr. Donnelly and others led me down a path of dredging up that work we had done with Jim Cloonan's book, Do Most Investors Look at Investment Risk Wrong? We mentioned it here last week. And as I went through the thread, Nick DiVirgilio had recommended this book, and I'm finding it to be pretty intriguing. I've started reading it. There's some areas where I think our methodologies would probably drive it across the goal line, and that's where I hope we end up. But sometime over the next couple of months, I think we'll be taking a much closer look at this. And I think it dovetails very nicely with a topic you and I have had of taking that utility, electric bill, auto pay demonstration portfolio and extending it a little bit further. In a nutshell, what McCormick is making the point is that every family needs a CFO and CFOs in training. And I think our methodologies dovetail really nicely with this. So it'll be interesting to see where it ends up. So that's in the future.
Sounds intriguing.
Thank you, Nick. And last but not least, our pictures for today are from what is now on Ken and I, our itinerary for our travels. Ascension.
Like a club visit there, huh?
Yeah.
Is this a picture of Alejandro, Mark?
I don't believe it is. This is just from the internet, where you can learn more about Paraguay and visiting the area, and that happens to be the governing palace in the Ascension. So with that, it is time for me to make a selection for tonight. So I'm not sure which way I'm leaning yet. Louis Vuitton, send me notes, guys. Louis Vuitton versus the companies that are in the vetted watch list for Buttonwood.
Why don't you go have a Portillo's dog with a side of fries while you're thinking about Mark?
Well, thank you. I'm sure we have some Lamb Weston products in our freezer for sure. Good stuff. All right. Anything else in the hopper, Ken?
No, we've kept up very nicely with the questions today. Mr. Galogli, I pronounced it correctly this time. Mr. Galogli has been tantalizingly sending us various stuff, and I've managed to avoid most of it. So, Kevin, we'll talk to you tonight, okay?
Yeah, he gets an unfettered microphone tonight, so we're all in trouble. All right. Thanks, everybody. Take care.
Hey, Mark, I have a quick question for you when you're off recording.
Okay. Hold on.